Mortgage delinquencies rose in the month of February, but mainstream media is basically saying the reason why it did rise is because February is a short month. I'm not kidding you. Welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Randy Patrick here, putting the realism back in real estate with real statistics, debunking the housing myths that go on out there these days. Today's the 25th of March. Hope you're all doing well. And I'm going to ask you a big favor, okay? If you're not already a subscriber, if you could do me the great honor and subscribe to my channel, that would be great. And secondly, if you think you're a subscriber, could you please check to see whether you really are a subscriber still? Because I'm having a lot of issues with my channel, and I'm actually losing subscribers on a daily basis now. So if you think you're a subscriber, check it, and if you could resubscribe, that would be great. I thank you very much. I appreciate that. You know, powers that be are trying to keep me down. All right. So this video is brought to us by Foreclosure.com. For information about we'll call it distressed property listings, go to gethousingdata.com. Check it out. It's a great service. The Foreclosure.com is probably the nation's leading supplier of distressed property listings, across the board. We talk about the distressed stuff. You're going to want to take a look at what's going on in your market. Go to gethousingdata.com and see what's going on where you live. And the best thing about it, they give you a 7-day free trial. And when you subscribe, it's only $40 per month. Gethousingdata.com to check it out. Thank you very much. All right, guys. So mortgage delinquencies hit the 6% mark in February. So really, this is an increase from January. So ultimately, it boiled down to we're using the Black Knight Financials, McDash, Flash, Forbearance, Tracker, whatever they call it these days. And they're talking about, they're just talking about all sorts of stuff, essentially, with respect to, forbearance numbers, ebb and flowing, delinquencies, the whole bit. But what it boils down to is that after 8 consecutive months of improvement, the national mortgage delinquency rate rose in February from 5.85% in January to 6.0% in February. So there you go. Regionally, the top 5 states in terms of delinquencies included Mississippi, Louisiana, Hawaii, Oklahoma, and Maryland. So there's some states that are having a surge in delinquencies. But when we go to a little different here, a little deeper into it, and we take a look at it, this is what I have to laugh when I see this. Loans that are in forbearance are counted in this survey because, yes, you're in forbearance, you're still delinquent, even though your loan, I guess, is on pause right now. They're reported delinquent. They are not reported as delinquent to the credit bureaus, supposedly, right, or allegedly. And so again, after 8 months, we're up a little bit here. The rise was largely calendar related. That's the first red arrow there, as February is both a short month and ended on a Sunday. All right, cutting the days on which payments can be processed, which has historically impacted performance metrics. Which I have to laugh at this a little bit because, I don't know. I look at this going, we're stretching for anything here. So, hey, we had an increase, but here's the reason why. It's because of less days in the month. So, what do the people on the other side say? So if we have a decrease, well, is it because we had 31 days in January and last day of the month wasn't a Sunday? Come on, guys, wasn't a weekend. So, you can look at it and spin it either way. That's what the housing market's all about. It's about fitting the narrative that suits you best, I suppose. Delinquency rates were seen broadly across, or increases were seen broadly across portfolios, geographics, and asset classes. The increase was primarily seen in early stage delinquencies, while the number of loans 90 days or more past due but not yet in foreclosure saw a modest decline. Prepayment activity edged up in February as well, but recent 30-year interest rate increases are likely to put downward pressure on prepayment rates as time goes on. Both foreclosure starts and active foreclosure inventory again hit new record lows, as recently extended foreclosure moratoriums continue to suppress activity. And they have a little bit thing below there called emphasis added, right? So at least they're acknowledging the fact that not much is going on in the foreclosure world because of moratoria and things like that. But again, it's just something that, we should take a look at. And we should realize that, it's still hanging around. Things aren't really improving. And I literally just got off a webinar watching some, people who were contradicting their information they presented, a couple months ago. So it's just, I guess it boils down to what sells, what's in the mainstream, what makes people feel better, things like that. That's how I look at these things, guys. We're going to have problems as time goes on. So basically what Black Knight does is they put together their information. It's the percent of loans delinquent and in foreclosure process. So we can see that according to them, February we're at 6%. It's a little bit above January. We see that the total properties that are either delinquent but not in foreclosure, and number of properties in the foreclosure pre-sale inventory are 3.354 million. So it increased from 3.301 million from the previous. I'm looking at. Oh, sorry, they didn't do a year over year here. I'm sorry. So I think they meant to say January 2021. Okay. There. So, because that was January 2021's number. So, anyway, it did go up a little bit from where we're at. But again, I look at numbers like the number of foreclosure properties in the pre-sale inventory. That's different from other statistics that I can pick off. So, realize that this is basically sampling, extrapolation, statistical analysis, getting us to some number, which as I always say, and I always want to caveat that in my videos, the fact of the matter is that I do believe that these are underreported and or conservative, because that's, I think, a trend from the provider, which is Black Knight Financial. I've noticed that with all their data over the past number of years. All right, so looking at it a little bigger here, again, 3.354 million, and that should say January 2021 because it increased from 5.85%. So they just did a typo there. So we were up, about over 50,000 total properties, are in the delinquent or added to the total as far as they're concerned. And that's sort of the number they're sort of sticking with respect to what's going on. Now, let's take a look at FHA delinquencies. So American Enterprise Institute produces this. It's a nice website, nice analysis, and we can take a look that in February, the delinquent numbers went from 17% in January to 17.5% in February, and the seriously delinquent went from 11.8% to 12%. So when I'm taking a look at what these guys are saying is I don't really anywhere see the fact that it's going, nope, I don't see it's because of the shorter month, and it's a Sunday. So these guys just report the data because you're right. Some months, February is a shorter month, I agree, but guess what? There's a lot of months with 31 days. So what are we doing? Are we looking? We're looking to average stuff out, and as you can see that December it was 17.4%. From 17.5 down November, went down to 17%. Then it popped up again. So who knows? I mean, but we're still looking at the FHA stuff is hovering around that 17 to 17.5% number. The serious delinquencies are slowly creeping up every month as well too. So please keep that in mind. If we take a look at what they produce, what's called the 10 most threatened metros based on FHA delinquency rates through end of February of this year. So we can take a look at this is how they rank them. So Atlanta, Sandy Springs, Alpharetta, Georgia is the number one location of we'll call it threatening, which basically boils down to percent of delinquent, percent of seriously delinquent, and share of metro lending, like how big a share of FHA loans in that area are delinquent. So that's how they sort of put together their top 10. So Atlanta's number one, Houston back up to number 2, Chicago, Naperville area number 3, Dallas, Plano, Irving number 4, the Washington metro area number 5, Riverside, San Bernardino, Ontario, California number 6, Baltimore, Columbia, Townsend, Maryland number 7, San Antonio, New Braunfels, Texas number 8, Orlando, Kissimmee, Sanford number 9, and Tampa, St. Petersburg, Clearwater number 10. So we take a look at the active portfolio. So you've got basically, again, percent of delinquent loans, 17%, 0.5% of delinquent serious delinquent loans, 12%, and then it varies based on a location. So you've got some locations that have some pretty significant stuff going on. That's your most threatened metros based on some of their analysis, which is a combination of total, serious, and FHA share lending. All right. Now, according to the American Enterprise Institute, it says as the forbearance period ends, one of two things will happen. Those borrowers who are able to resume normal payments may elect to have their arrears deferred till the loan is paid off, which would result in those loans becoming current. Borrowers who are unable to resume normal payments or who elect not to remain delinquent. As a result, total delinquency levels are likely to fall, but serious delinquencies are likely to remain high. Unless able to sell their home, those borrowers who remain seriously delinquent are likely to head into foreclosure or other dispositions. So what they're saying is that, hey, there's a portion of these people who will not be able to cure their mortgage and actually resume the normal payments. All right. And when we take a look at some of the information with respect to forbearance and things like that, one of the main issues is people still in the forbearance program. So you can read and you can hear about forbearance volume and the fact that there's new forbearance numbers are down dramatically since the start of the COVID pandemic. However, the people who jumped in the first couple months, 80 some odd percent are still in the program, and they're re-upping. So in other words, once your forbearance period is over, you're going back into a subsequent one. So those are the people that will have a difficult time with respect to moving forward and paying their mortgage on a normal basis, normal payment, etc. So that's where we're going to see a good potential of pre-foreclosure opportunities hitting the marketplace or becoming available. So just keep that in mind. So and as I said, I just spoke. I was listening to a webinar a few minutes ago, and it's almost like what was spoken about 2 months ago is change narrative today from the provider who was doing the webinar. So I had to laugh at that, and to me it was a downplay of numbers. They basically were manipulating statistics and analysis to suit the narrative, and that's hey, I guess that's what I do, right? I just try to be realistic and go, this is the potential we could see out there. If it's better, then we're all better off, I suppose, right? So anyway, this is interesting. So if you take a look at, so that was the top 10. They have 100, and so this American Enterprise Institute produces 169 metro service areas across the board. So you take a look at this is just the first page I just sort of saved and captured here. But if we take a look at that, I can give you examples of what's going on. So you've got locations where for example, New York, New Jersey, White Plains, 24.2%. Los Angeles area, 20.2%. Newark, New Jersey, 23.5% delinquent. Camden, New Jersey, 20.9%. Fort Lauderdale, Pompano Beach, 22.7%. New Orleans area, 23.3%. So when we start taking a look at some of these numbers here, there's some pretty significant locations that have this, 20.7% in Gary, Indiana. Baton Rouge, 22.1%. McAllen, Edinburgh, Mission, Texas, 21%. Bridgeport, Stamford, Norwalk, Connecticut, 21.8%. I always say this wrong. Poughkeepsie, Newburgh, Middletown, New York, 24.2%. So, there's a lot of locations that maybe didn't make the top 10 how they do their analysis, but still have a significant amount. Shreveport, Louisiana, 21.1%. Corpus Christi, 21.3%. Lafayette, Louisiana, 23.4%. Beaumont, Port Arthur, Texas, 20.8%. So when I actually take a look at all this, that's quite a bit. And these are, again, this is looking at 169 MSAs across the country. Well, if I just pulled and did some, basic peg count, simple math here, 21 MSAs out of the 169 have greater than 20% delinquencies. All right, 14 MSAs are between 19, so greater than 19, and just less than 20% delinquencies. So they're like, you could be 19.8, 19.4, 19.6. So they're approaching 20% as well too. Now the Nassau-Suffolk MSA, so that's sort of the Long Island area of New York State, at 24.8% delinquencies, they lead the nation in FHA delinquencies. And, when you take a look at that, it's kind of like, well, why is this a problem? Well, this is the sleeper, all right? And what I mean by the sleeper is that if you go back to the last housing crisis where everybody, knows what happened, and you basically, I guess you could say, a lot of people sort of make the correlation that the last housing crisis was sort of based on the subprime mortgage meltdown. And, I speak about this kind of often, and the fact that, that kind of started it off, but in the end, it was the cash-out refis and equity stripping that really was the problem for homeowners back last housing crisis. But, everyone talks about why we're not going to have a housing crisis and housing issues because, and this was on the webinar I saw today, and I'll go through that webinar in a future video and sort of debunk all that. But, the number one thing was we have tighter loan standards and better loan guidelines. It's not like 2008 when we had all these subprime things. Okay, well, interesting enough. Well, when I take a look at what's happening right now, what has changed over the course of the past few years? Well, FHA has become really the new subprime loan. Well, why is that? Well, because they do offer lower credit score loans, right? You can get in an FHA loan with I forget the number, it's like a 640 credit score, all right? You don't have to be in the high sevens or 700 plus, whatever. So you have a lower credit score limits to get in. We have what's called the QM patch, the qualified mortgage patch, which allows for a higher debt to income ratio. Your typical max debt to income ratio is 43%. And the QM patch allows for borrowers to have a greater than 43% debt to income ratio, which is not that great. And your FHA loan also allows for a smaller down payment, 3.5%. So when you take a look at stuff like that, I mean, to me, that is a subprime in itself. It's lowering standards. So that's why I have to laugh. And this is where I'm not getting emotional or upset about it, but I just have to go, why are we not talking about, or why is the mainstream group or housing, hype hack people not acknowledging this? They keep going on the flag saying, we have better lending standards and guidelines. We're not going to see what happened. Yet, the number one, like first-time home buyers, where are they going for their loans? They're getting FHA-backed loans, all right? FHA lending is a significant portion of what's happening right now in the marketplace. And how this is proved out, if you really want to get into it, all right, is you prove it out. Let me go back a slide here or two. All right, I'm going to go back 2 slides, 3 slides actually. So, look at this chart, and the right-hand column is FHA share of metro lending in 2019. Okay, so that chart is the amount of delinquencies or loans that are delinquent that are FHA that were originated in 2019. So when you got it's 14% of all the loans that originated in 2019 are delinquent, and you start going to the column, like going, okay, well, 21% of the loans, FHA loans originated in 2019 are delinquent. You know what I mean? Like, so I guess the point is, that's a pretty substantial number. So it's like recent vintage loans are delinquent. So if we have tighter guidelines and tighter lending standards, why are we seeing 20% or 15% or anything in between share of loans originated recently are actually in this situation here? So that doesn't make sense. So really, these tighter lending guidelines, FHA blows that argument right out of the water. So please realize that. And that's, as I said, narrative is what you want it to be. I want my narrative to go a certain way. I try to support my narrative by real statistics and show you guys that. Whereas, when I'm listening to other webinars and reading other articles and stuff, it's kind of like we just talk generically about things. We talk about, they'll talk about equity and blah, 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 and, better standards. Well, they're not really addressing what we call the elephant in the room, I suppose, here. So please realize that, this is what we're seeing. And, I would assume that, with price points going up where they are these days, I'm going to assume that a lot of lending is still FHA based. So maybe today standards are tighter the past few months, but it certainly wasn't 2018, 2019 leading up to the pandemic. All right. And also, please don't forget that a lot of share of lending that's going on is non-bank. Okay. Non-bank, which is, not your, Wells Fargo, JP Morgan Chase, Bank of America, like your significant, your normal banks. They're doing qualified mortgages. A lot of the lending the past number of years has been non-banks, which you could almost say is somewhat subprime. They're catering to a different clientele and maybe a different market. So again, maybe the standards aren't as great or as tight as we'd like to think they are. Please remember that. Forbearance activity drops below 2.6 million, at first since April. So really, this is the first time that forbearance has dropped below 2.6 million active forbearance. And, I'm not going to get into this too much just because I'm looking at it going, all right, there's so many reasons why, these numbers can go up or down. Put it this way, of the 1.2 million homeowners in forbearance whose plans were scheduled to expire at the end of this month, which is March, some 66,200 March end expirations remain. So we don't know, how can I put it? There's more that are going to expire, but are these people going to re-up, you see? And the people that already expired, did they re-up? I guess that to me is the biggest question here, is the fact that we talk about the issues with respect to forbearance, the fact that the government and the CARES Act is allowing an extension so you can do a full year. we're going to give you 3 more months, and maybe even 3 months on top of that. So you technically could be not paying your mortgage for 15 months, maybe even 18 months, and your forbearance. So when we see these numbers growing and increasing and decreasing, it could be because you've technically finished your forbearance plan, but you've not decided what your next phase is going to be. You see, so that's why this is kind of a wonky number here, and I just think it leads a lot to be desired with respect to what's really going on in the marketplace. And also, this number is based on samples, extrapolation, statistical analysis, a whole bit. It's not a true pay count. So please remember that. All right. So when will this crazy market end? It can't be sustained. Talking to people every day, and I just know what's going on. Everyone's frustrated, can't find properties, don't know what to do. But what it boils down to, people don't want to pay these high prices, and I don't blame anybody for doing that. So again, going back to the fact that we're talking 3.34 million loans that are delinquent. Well, I can tell you that that's not an accurate number. We get conflicting statistics. The number is actually much larger than that. And when you start really digging and delving into it, you see that it's one of those things where the discussion points are all about don't worry, don't worry. I think we should be worried. Will this be like the last housing crisis? Probably not, but because it's going to be a controlled meltdown or a controlled crash. Various metro bubbles will happen. Some places will increase, some will decrease. It's all going to sort of average out, I suppose. Just you have to watch your own market, but you need to be aware of what's happening in your own market with respect to the distressed property numbers and things like that. So as I always mention, the discussion point always revolves around things like, hey, you got equity, you can basically solve your problems. Yeah, you possibly can, but the longer you wait, you're eating up your equity, and there may not be much equity depending on where you live, and the state foreclosure laws and rules and policies may not work favorably for you depending on what's happening in your local area. All right, so short sales, other pre-foreclosure sales are poised to become more dominant share of the distressed market. I've sent out lots of marketing the past week and starting to go out and do field drive-bys and things like that. That's what I am going to be doing and going to be doing a lot more these days. Pre-foreclosure sales set to dominate the distressed home market. So yeah, that's basically a discussion point that people are going to have to sell, and if they have any equity left, they better sell sooner than later, because that equity just gets eaten up, and then they're going to find themselves stuck with having an albatross and not nowhere to go and nothing they can pull out of it. So various markets, some markets like West Coast markets will have some equity, some markets don't have equity. So again, depends on where you're located, depends on foreclosure timelines and things like that. So there's a lot of variable factors that are going to play in various metro bubbles here. But the whole point is that and this is, again, the 2020 is an extrapolation, it's an estimate that 49% of sales were pre-foreclosure dispositions, as opposed to we can see that the actual foreclosure volume is down. I think that foreclosure auction sales should be less than 14%, and REOs will be less too, just because there's just nothing happening out there. All right, but again, it's distressed home disposition, so it's all relative to the amount of distressed homes that are being disposed, I suppose, which haven't been a lot over the course of 2020. Now, remember, 1% of all the on-market property sales fall into that distressed property category. They're REOs, which mean bank-owned, short sales, which are the pre-foreclosure stuff. No one is doing short sales. How do we know this? Well, back to that 1% rule, which I'm going to show you right now. We talk about this every time. The Realtor Confidence Index survey that NAR puts out for existing home sale report every month, the distressed sales are only 1% of the marketplace, which is half of what it was this time last year. Distressed sales are made up of REOs and short sales, which means half a point to each of those categories there. And so that means not much has happened. So foreclosure filings are quietly increasing. More properties are scheduled for foreclosure auction. Going back to the 1% rule, it's not much is happening. So that's the opportunity to get involved with that. So, and that's on market. So there's lots of off market and stuff sitting around. Just they're not on market, which means on the MLS. So that is what I'm talking about, guys. And to talk a little bit more than that, what's the next opportunity? Well, there'll be more distressed properties coming. That basically is a given. Owners will need to sell. The longer they wait, the less money they're going to have. Investors are going to have to liquidate some of their properties. We'll see an uptick in foreclosure auctions. We'll see an uptick in the near term because as stuff opens up, the properties that were in auction process will get back into it. We'll see an uptick in foreclosure filings as that opens up more, and we'll eventually see an uptick in more short sale listed, and eventually an increase in REOs because stuff will be going to foreclosure. There will be more available than predicted, but we are not seeing the true numbers right now. So again, keep all this in mind. So sorry, I just popped through that pretty quick there. So I have a new product out there, it's called Zombie Foreclosure Flip. Basically, it talks about all the distressed property opportunities and retail buying, how to save money. You might want to inquire on this because you'll learn a lot about what's happening in today's marketplace. All right, example, this is my market, Tampa, St. Petersburg, Clearwater, MSA, 4-county area. Look at the lack of inventory, 0.9% or 0.9 months, I always say percent, 0.9 months worth of inventory. What that means in real terms is the fact that if no new listings came on the local MLS, it would take less than a month for all the current properties to be sold, and there'd be nothing left. So pundits, gurus, I guess the customary information that floats around out there basically states that 6 months of inventory is a healthy, balanced number for buyers and sellers. So keep that in mind. When we take a look at this MSA, this is the median sale price, and this is for January 2021. They have not produced the February MSA number yet. It'll probably come out in a couple of weeks, so this is the most recent statistic that I have. You can take a look at the median sale price for the MSA of just a single-family homes. Doesn't include condos or investment homes or mobiles or manufactured or villas or townhouses, just single-family homes. That's what I'm just talking about right now. So the median sale price of a single-family home in the area, the MSA, was $285,000. The median sales price for a foreclosed REO property is $180,000, and for a short sale is $194,500. Now you can take a look at 31 foreclosures were sold. Again, these are not auction; these are taken back by the bank, sold in the MLS, all right, as inventory. And short sales will be 21. So you can see that the number of homes is virtually nothing, makes no impact whatsoever in the numbers that we have across the board. But when you take a look at the median, and again, it could be a bit skewed because of the lack of volume. But the point, though, is that off the top, short sales are making 0.6% of the single-family market. If you take a look at that discount, it's a 32% discount over retail, about $90K in equity there. So that's not bad for an average retail short sale. I can tell you that how we run our short sale opportunities, we do things a lot different than retail real estate agents do it. We have a whole complete system on how we do this, so we can push that value down even more. Thus the opportunity, thus the reason probably you should be talking to me about this type of stuff, right? All right, so that's what's going on. And once again, different locations will have different opportunities here. This is my backyard, so I can have this information. That's why I can show it quite readily, all right? So if you want more information, I'll tell you about it. Just connect with me, and that's my email. Send me an email. Tell me what you're looking for. Make sure I have a way to contact you, which is a phone number, and we'll go from there. So once again, thank you for the views, likes, comments. If you're not already a subscriber, please subscribe. Share the video with your family and friends. And if you are a subscriber, one more favor, please check your subscription. Get the notifications turned on if you can, and make sure you're still subscribed, because as I'm telling you, some weird stuff going on my YouTube channel. Weird for me. We know what's going on behind the scenes. So I'm losing views and I'm losing subscribers from a pay count perspective, but I know people are watching my videos. Anyway, long story short, we'll get into that in a future video, but thanks once again. Looks forward to speaking with you guys in another video, maybe over the weekend, all right? Take care.